Welcome back, everyone. Michael with Offshore Citizen, continuing my conversations around investing. Been doing a few of these lately. We're going to talk a bit about the subject of the three things that you're always investing in anytime you make an investment, and these three things can screw you over if you don't realize it, or they can help to boost your returns. And this has been enlightening for me. A bunch of these, one in particular, has got me into trouble on numerous occasions. And so I'm going to point it out to you and hopefully help you to mitigate it in the future. And yeah, hopefully you learn some things and it helps to improve your investing, and we'll see from there. If you have any questions, please put them in the comments below. Excited to find out what you guys have to say about your investments and your experiences. Would love to hear if you guys have something to share, like, hey, listen, here's some investing lessons I learned. Please put them there, and yeah, we'd love to hear it. Before we move on, if you haven't already, please subscribe. Really appreciate it. Hit the subscription button and the notification bell, and do the little all so you don't miss out on any of our future videos. If you'd like help with international structuring for your business or yourself on the strategy side or the implementation, you want to form companies, open bank accounts, get residencies, citizenships, please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer, link in the description below, or you can check out our websites, offshorecitizen.net, offshorecapitalist.com, and send us a message through there. Okay. So anytime you invest, you're always buying three things. What are the three things that you're buying? I would love to hear if you knew. Number one, you're buying an asset. Okay, most people probably know this. Okay, we're buying some sort of an asset, right? What that asset is a little bit questionable. We're going to get into that in a second. The second is you're buying an instrument. Okay, this is probably the most overlooked of the three. And third, you are buying a denomination. Okay, so denomination, what is that? That's basically a currency, right? So let's look at this as a simple example. Say I go and I buy in Turkey right now, okay? I buy a piece of real estate. What is my real asset? Now you might say the real asset is the real estate. You might also say the real asset is the renter, right? The denomination is definitely going to be Turkish lira. So we're talking about denomination right now. So what's the problem here? Even if it turns out that the asset and the instrument are good, if the denomination is going down, that could hurt your returns. The flip side is also true. If the denomination is going up, it could help your returns. So who's his face? Famous investor, the motorbiker guy, Jim Rogers, he kind of did some investment in Russia, and he happened to he invested in a Russian asset, Russian bonds in Russian rubles. It was pretty high return bonds, but on top of that, the Russian ruble went up a whole bunch while he was doing that. So he kind of got this double boost, right? This is a very important thing to pay attention to. You could go and you could buy bonds in, say you bought bonds in Malaysia and the Malaysian ringgit dumped. Well, the bonds could have been paying you a really high rate of return, but, turned out you didn't make anything because that took away the returns for you, right? So very, very important. I know a very smart investor, a good friend of mine, who one of the first things that he does is he kind of looks at the macro of which currencies are going to do well, and that's part of what he figures into how he invests. So for example, he's investing in UK a lot right now, right? So it's like, okay, he thinks the British pound is going to do well. Obviously he's been right over the last year, and we'll see how it does over the next little while. But basically that acts as an upward pressure on his returns. Great, fantastic. If he's going to be repaid in this currency and is living in another, that's an advantage. So that's denomination, right? We always want to pay attention when we're investing, and this is something that people who don't invest internationally or don't think in terms of international markets miss. I remember in Vancouver one year, Vancouver, Canada, the real estate market had gone up a lot, right? People were in Vancouver, people were thinking, oh my gosh, it's crazy. But what they didn't see is that the Canadian dollar had dumped during that time. So on the international market basis, actually Vancouver hadn't gone up that much. So it's worth it to consider what is the denomination you're measuring in. I remember hanging out with some guys, some old guys who had said, hey, gold's dropped today. And someone was like, what are you talking about? Gold went up. And they're like, no, the US dollar dropped, which made gold, which was priced in US dollars, look higher. But if you compared it to euros or pounds or Swiss francs or whatever it was at the time, it actually went down. So again, just interesting perspective that a lot of people miss, and I think is worthwhile to consider. Let's go over to the opposite end, which is the asset, right? So asset prices can of course go down or they can go up, right? If I'm, let's say, investing in, I don't know, a property, right? of course, the value of the property can go down, the value of the property can go up. If I'm investing in a business, right? Okay, the number of customers, the amount of the profitability of those customers, et cetera, it can go up, it can go down, right? Fairly straightforward. We're used to thinking about the assets, so I'm not going to spend a ton of time on that. Where I want to spend the time on is the instrument, because I've got screwed on this instrument thing a few times. And I'll give you an example. The first time that I really got, second time that I really got burned on this was when oil dumped. When was this? Shoot, maybe like 2016-ish. I don't remember exactly. But anyway, basically oil had been up at like $100 a barrel, dropped down to like $70 a barrel, dropped down again to like $40 a barrel. And I'm like, man, this is a steal. For sure it's going to go back up. At the least it's going to 50. I think it's going to 70. And it turned out that I was right. It went up a lot. I think it went up to like $65, $70 or something. And I lost money. Why did I lose money? I lost money because I bought USO. So I remember I was sitting around this table with some friends, and one friend, we were talking about this, and he was like, yeah, it's a great deal. I agree. How are you going to invest? Are you going to invest in oil companies or something? And I was like, no, there's management risk there. There's all these different things I don't understand how to control against those. So I just want to be exposed to the asset. I'm buying oil, right? How am I going to buy oil? Well, I don't want futures to expire. I don't really understand the futures market well enough, things like this. I'm just going to buy USO. It's an ETF. It's supposed to match the price of oil. I should be good, right? Well, what I didn't understand is there's this thing called contango, okay? The way contango works basically is that, so USO as there's a whole bunch of different things about why it doesn't perform the same as oil does. But one of the reasons is they buy futures contracts and they roll them over each month, right? And what happens is as the value drops, they can buy less contracts the next time, less and less and less. And then you end up on the other side. So it works, if the price of oil is going down, it works bad for you trying to come up on the other side. That's basically what ends up happening. So yeah, not so useful in this particular situation. So as a result, even though the price of oil went down and then went back up, the price of USO dropped and it went up a little bit, but it didn't follow the same thing. So that was a lesson for getting burned. Another good example, back in 2007, real estate going crazy, everybody's wanting to do this, everybody's a developer. And so a close friend of mine, somebody who became a close friend at the time, was pretty new to me, was involved working for this real estate development company. And they were pitching this real estate deal, right? Sounded great. It was like, you buy this thing, a year from now, you're gonna double your money, it's fantastic. When in doubt, you own real estate. So you can't, you'll own the land. At least you'll own the land. 100% loss for investors. In fact, I think this company had like $70 million worth of projects, all of them 700% loss for investors. How could this happen, right? It's a solid asset, right? I mean, the real estate, you did the research, seemed fine. When in doubt, you would own the real estate, right? Problem is you didn't own the real estate. Instead of buying the real estate, you were buying a limited partnership share. Well, when you buy a limited partnership share, you're exposed to management risk. So what happened here? Well, the general partner went and they borrowed money against that property. They didn't manage funds very well, right? They were spending too much on fundraising. They weren't very efficient at project management. They were all these different things and basically ran out of money. They had loans against this property, and therefore the lenders came and collected all this property, and the people who invested were left with nothing. So this is another example of instruments. And to this day, I'm wary of investing in limited partnerships because of this. I had a call the other day with some people in Cyprus, and we were discussing a little bit about, in order to qualify for Regulation 6.2 of the Cyprus, it's like a permanent residency scheme. I did a video on it recently. In order to qualify for that, you could buy into these funds, right? And I'm like, oh boy, most of these are limited partnerships, right? Does that mean they're going to do badly? No. I mean, most VC funds are limited partnerships. It's a common investing structure. But you have to understand that when you're buying into a limited partnership, you are not buying the underlying asset. That is an instrument, right? What you own are shares or membership units, not the underlying asset. And the underlying asset can perform dramatically differently than the actual investment itself. You could even argue that this is the case on the stock market, right? You're like, hey, I'm buying shares in this company. How is it that those shares will do dramatically better than the company itself, right? For instance, Apple The shares, I think it was from 2018 to 2020 or something, doubled, but the company's profits remained flat. How did that happen? Well, the share price went way up, but the company fundamentals didn't change that much. That can work for you or that can work against you, right? Lots of just different examples of this. So always be mindful of what is the instrument that you're investing in and that you understand the instrument, not just the asset, not just the denomination. So I hope that helps. It's kind of an interesting paradigm that I don't hear a lot of people talking about, but as somebody who got burned on it a few times, it definitely is something that I think about a lot and hopefully is going to be helpful to you. So we'd love to hear, investment lessons you guys have learned. Put them in the comments below. If you like the video, give it a thumbs up, share it with your friends, and I'm going to look forward to seeing you guys on the next video.